In today. My name is David Weiss, and I am the Vice President for Finance at DuPage Foundation. On behalf of our Board of Trustees, Investment Committee, and staff, it's my pleasure to welcome you to our latest quarterly webinar with our investment consultants and partners at Northern Trust. Today's webinar will focus on the Foundation's main investment portfolio at Northern Trust and include a discussion on the current economy and its future outlook. Before I introduce today's participants, give me a minute to share a few housekeeping notes. Today's webinar is being recorded and will be made available to all participants after it concludes. With regard to questions, we invite you to submit them throughout the program utilizing the Q&A feature at the bottom of your Zoom window. We will address them during a segment or near the end of the hour. If you have a question specific to your fund at the Foundation or need additional information on today's information, please feel free to contact us at the email that I'll provide in the chat in a few minutes. A few brief introductions. Today's speakers from Northern Trust are Marty Morris, who's Senior Vice President and Senior Portfolio Manager with the Foundation and Institutional Advisors Group. We also have Ryan Boyle, who's Vice President and Senior Economist with the Global Risk Management Division. And finally, monitoring the chat and Q&A is Matt Wilson, our Finance Officer at DuPage Foundation. With that being said, we turn it over to Marty and Ryan. Guys, take it away.
Great. Thanks, Dave. I'm going to start sharing my screen here so everybody can follow along at home. So thanks, Dave. Good morning, everyone. It's great to be back with you. This is our second quarter in a row where we're doing an economic and investment portfolio review. We've got a full agenda today, so I'll just dispense with the introduction of Northern Trust and maybe just give a few comments, just about our Foundation Institutional Advisory Group, in case there's any new faces on the call this time. I am Marty Morris, a Senior Portfolio Manager in the FIA, or Foundation Institutional Advisors team at Northern Trust. The FIA is a dedicated nonprofit practice within Northern Trust. We work with foundations, endowments, other nonprofit organizations, working as discretionary investment advisors, primarily as an OCIO, or outsourced chief investment officer, for those organizations. Some of our stats are on the bottom of the screen. We have almost 400 clients across the country. Our AUM currently almost $15 billion. Split nicely between foundation endowments, other nonprofits, and defined benefit plans. Real quickly, there's a shameless plug for FIA. Why do people choose to work with us? We are experts working with investment portfolios for endowments and foundations. We partner with organizations we work with, providing customized solutions and comprehensive resources for all the nonprofits that we work with. As a quick introduction to our special guest today, Ryan Boyle. David gave a really nice introduction to him, but I'll just kind of add my 2 cents. Ryan's going to provide a really unique view into what's going on in a very tumultuous year that we've seen in 2022. He's a valuable resource for our FIA team and other partners at Northern Trust across the whole wealth management team. And I would add that he works closely with someone I consider one of the best in the business in the economic world, Carl Tannenbaum, a proud resident of DuPage County, I should add. But with that, I'll pass it over to Ryan, for his update on the economy.
Thanks so much, Marty. Hello from Mr. Tannenbaum's office. Make use of a shared space. He's been a delight to work for as I approach my 5-year anniversary here at Northern Trust. What a 5 years it has been. I joined just as the trade war kicked off, which, by the way, we never really concluded. We just sort of moved on to other problems. Then a pandemic, now a year of regional war and energy crunch, a lot of recession speculation, some understandable, some less so. So I'll be digging into all of that. I don't know if it's good news when my job is interesting, but It sure has been interesting over these past few years. My favorite part of the job is getting questions from clients, from my colleagues at Northern Trust. I so enjoy the engagement. I look forward to your questions as well. I'll shoot to go for about a half hour here and leave some time for questions at the end. So please keep them coming, even in the chat would be great. Some questions have really been repeated throughout the year. I'm getting more than usual, and some of them are honestly pretty dour. So I've grouped those questions that I keep hearing throughout this year and used them to anchor this presentation. It's not a complete overview of everything going on in the economy. That would take way more than half an hour, because again, what a year it's been. But let's dig into some of these questions and give our latest thoughts. So first one that's a bit introspective here. How did we, and by we, I mean the entire economics and finance profession, how did we miss the risk of inflation? You know, behavioral economics has given us some useful insights, and one of them is recency bias. We tend to gauge today's experiences by whatever was most recently on our minds. You know, prior to last year, when's the last time anyone really worried about inflation? Honestly, not in my adult life. I'm sure there are some in the audience older than me who do have memories of the 70s. I don't mean to wave away inflation. It's a real risk. It's a real pain, but we hadn't seen it for so long. Look at how Bloomberg Businessweek depicted it for us. It's a dead dinosaur. But think of the most recent cycle we went through. We had, a pretty good growth cycle in the early 2000s that turned out to be overheated, especially in the real estate sector. And even in that boom economy, inflation never really took off. Then a bad recession, then a very slow recovery where the challenge in 2010 through 2020 was getting people back to work, especially in the early stages of that recovery. We were worried about employment. At no point did we really worry about prices. Oil was a little high to start before we figured out fracking. Other than that, inflation was just never a worry for a lot of good reasons. Really, my entire life, we have been in a world of lower inflation due to a lot of structural forces. Think of globalization. We got really good at building anything where it was most cost effective to do so, and we got good at shipping it around the world. So costs there were pushed down. Was a huge factor. Think of e-commerce. It became incredibly easy to comparison shop. Find the best price for just about anything you wanted. It doesn't have to just be consumer goods. This is really true for B2B and everywhere. It became so easy to find good prices. Everything was very competitive. Prices stayed low, and we just weren't thinking of inflation. And it made us think inflation can't come back. Even look at these forecasts back in 2021. As we knew there was a recovery in sight, we were likely to see no doubt a better year in 2021 than 2020, but there were no forecasters that expected high inflation, nowhere near the rates that we actually saw. Was this avoidable? I don't know. I don't think so. We were ultimately, I've got some good news here. Why did inflation take off last year? It's because we had such a great recovery. Turns out we recovered a lot faster than the economy had the slack to accommodate. This is true whether you look across supplies of goods, supplies of labor, availability of services. Everything was really booming last year, and we are still catching up to that rapid pace of reopening. So it caught us off guard. It's been hard to adjust our expectations. It's been really dangerous to call a top, but we're probably there. I no longer confidently say we've reached the top, but we are probably close because we've been disappointed for quite some time, really going back to last summer. The theme of last year was transitory. This inflation is transitory because we could explain it. It all came back to the pandemic. Things closed down in 2020. None of us had ever experienced a year quite like that. And then we reopened in 2021 in a big way. So it was no surprise that where we saw the hottest inflation were sectors that you could explain with the pandemic. Travel got expensive. Airfare, hotels, no surprise there. We all canceled our vacations in 2020. We were revenge spending. We were taking 2 vacations or 3 in 2021, getting out while we knew we could. We weren't going to take it for granted anymore. So of course inflation took off there. Car rental, related to travel, but also supply chain disruptions that tie back to the pandemic. Car rental fleets sold off in 2020, knowing that their business was going to be low, and knowing that in every past cycle, they could just buy more cars as business picked up. But as we know, auto manufacturing has been really slow to recover. They weren't able to restock, and car rental got expensive. There again, a pandemic story. This is transitory. This is reopening. This will pass. And look, middle of 2021, look at that year-over-year line, flattened out. 5% inflation, higher than we'd like it to see, but it's leveled off. It's transitory. It's going to pass. Then what happened in fall? It got hotter and hasn't yet cooled off. We get occasional relief on those monthly readings like we saw in April, not nearly enough to cool us down. Now, there's reason to believe it gets better from here. What drove it this year was the energy shock. Coming back to Russia's conflict in Ukraine, there's nothing good to say about Ukraine. I'll have more to say about it later, but at least it's the first crisis we've had that's not related to COVID, but certainly made energy markets go wild. There are concerns about availability of commodities, especially food. So as we look at the past few inflation readings, where it's been hottest has been those non-core sectors of energy and food. Look what's happened to gas prices over the past month. You don't have to study it. You just have to own a vehicle or walk past a gas station, even if you don't, and you see prices are coming down. So we're going to see month over month, it's going to be lower, and the run up in food appears to have stopped. So there's reason to hope that horrible 9% reading will be a one-off, that we'll look back on that as the peak. But that said, once inflation starts to take off, it's hard to contain and it becomes pervasive. When energy prices move up, that flows into anything that uses energy, which is just about everything you might buy. But we're tracking specifically shelter. We're seeing rents move up in terms of the indices of real-time asking rents, or of course, homeowners are probably well aware of what's happened to house prices lately. We have seen prices appreciate ridiculously. 20% increases in house price indices year over year. That's massive. In the CPI index, it's a lot slower for that to show up. There they try to average out the typical consumer experience. Your typical consumer did not just buy a house in the past year. Most of us perhaps rent or perhaps bought a house pre-pandemic, in which case we've missed the worst of this inflation, especially if you locked in a nice low mortgage rate about a year ago. It takes a while for that average to tick up, but it is ticking up. In the case of rental, they average out all leases currently in force without any particular favor for new leases that are showing that appreciation. This is going to stick for a while. Hopefully it cools soon, but this is going to run well above target for at least the next year, and that's going to make inflation more persistent. So recovering doesn't mean recovered. We'll be on our way down for probably the next year to come, but yet there are reasons to believe the worst is behind us. Now, are we going to feel it anytime soon? I've hit on some of this, especially in energy. Hopefully you're less worried. Hopefully it's not as painful now as it might have felt, especially through the first half of the year. Especially the more you drive, the more you felt it. My family took a driving vacation from Chicago out to North Carolina and back. Had to revise the budget a bit on the way to that trip. And now I can see gas prices are coming down. This is a cold comfort. For one, we are insulated from the worst of it. The big driver of uncertainty in energy markets was Russia's invasion of Ukraine. What's about to happen to home heating costs over the winter to come in Europe is going to be incredibly painful, potentially a tenfold increase in the cost of heating homes. That's going to burn. Natural gas can be traded globally, but not easily. It's difficult to liquefy. There's only so much capacity to liquefy and to ship it. It's mostly a domestic market. We have a good reserve of natural gas, so we're insulated from the worst of it. Oil, of course, is globally traded, but appears to have peaked. Oil is an interesting market in that we got used to very cheap oil. Here again, cold comfort, but the way I look at it, from about 2014 or so, as oil prices fell through 2021, as they started moving up, things were sort of artificially low. what was happening in oil markets starting around 2014? We figured out fracking. We learned how to extract shale oil efficiently enough to bring the suppliers online from North Dakota and central Canada and so on. Good news in terms of oil supply, but that prompted a reaction from global markets. OPEC producers specifically did not like this new source of competition, and they can produce oil much more cheaply than the fracturing process. So they flooded the market and brought prices down and tried to squeeze the frackers out of business. And they succeeded. Many of them were barely limping along at low oil prices. Then when the COVID crash hit and oil demand went away for a few months, most of them didn't survive. A wave of bankruptcies ensued. So OPEC met that target, and now the capital in the oil market is really cautious. They've been stung, and that's a recent memory. You would expect $100 barrel oil should bring some production back, and we just haven't seen it yet, because what if there's another crash? What if they have more stranded assets out in the Bakken oil field? So we have not seen that come back. That also assumes that the equipment and the manpower and the trucks and everything they need to get a shale well dug is available. And of course, we have supply constraints across all of those that have made it more difficult to spin up shale oil, and fear of regulation. We haven't really seen laws change yet, but understandably, there's a movement to get away from some of those more polluting sources of energy. So I can see why the capital is cautious there. That's why I don't think we'll see $2 a gallon gasoline anytime soon. In fact, that would indicate an economic crash I wouldn't welcome. I don't think this helps anyone feel better today. Looking back, we sort of had a discount, and that's gone away. That's my little oil tangent. In addition, we saw the prices of goods move up. Big supply constraints as everything coming out of Asia just encountered problems. Not just in Asia, of course, but really every step in the supply chain had problems. We were complacent. We were lulled into thinking because everything worked well, nothing could break, right? We figured out this whole global trade, global economy thing. We were so good at extracting the raw materials, shipping them to the factory just in time. We all went to business school, learned about the Toyota production system, how to extract every efficiency, get everything just down to the perfect timing. It all worked so well until it didn't. Started coming apart in 2020 and just couldn't recover. It was especially bad through 20 and 21 as lockdowns continued around the world. People were still getting sick. There were worker absences for long times. So everything came apart in 21. It took a really long time to restart. And we're still not back to normal yet, but we're through the worst of those 100 ships waiting to unload outside the ports of Southern California. And we see it in prices as well. The cost of shipping predictably went very high in 2021 and is recovering. Not back as low as it was per container, but a very encouraging trend there in terms of getting goods inflation back under control. Let's shift from there to labor, another source of inflation, because we've seen some wage pressures here. Labor was a fascinating story to track over the past year, and overall, this is good news. We saw a slow but overall strong recovery. The challenge last year was wondering, where did everyone go? Why weren't people getting back to work? We did make good progress. I mean, in the depths of it, as of April 2020, we were down, I think, 22 million payrolls from a starting point of about 150 million. I mean, just massive job reduction there. And then we bounced back quicker and stronger than we expected starting in May 2020, and we kept coming back, but 21 was a challenge because we were still millions shy and the recovery was not as fast. It was unlike any past cycle where you would expect there's kind of a classical pattern where a recession hits, employers cut jobs, they downsize, and it takes a while for them to see the new demand and to regain that confidence to start hiring again. So we expect prolonged unemployment. In this case, demand for employment bounced back a lot faster than people were ready to come back. I wish there was a single story that could tie this together, but there are so many veins we have to track. Some of this is mixed news. Some of it is, of course, bad. What we're still tracking in terms of where the remaining recovery will come from. How much is left to recover? It's about 500,000 jobs from where we left off in Feb 2020. We'll get a new employment report tomorrow that might cut that even further. So from 22 million, we're down to just 500,000 jobs, payrolls that have not come back. We do think they can yet recover. We are paying particular attention to just a few examples, and there's a lot of drivers here, but look for early retirements. Retirement doesn't have to be a permanent condition. A lot of older workers were at greatest risk of COVID, understandably took that as a time to get away from social contact in the workforce. And anyone who had a retirement portfolio did really well in 2020 and 21. So they were feeling rich. But some can get bored. Some may find their retirement and Social Security don't go as far as they hoped. So we can see them come back. And we saw that in that last long cycle, toward the end of it, older workers' labor force participation ticked up. There is room for them to recover. We're watching childcare. This is a tough time for parents of young children. Childcare was never cheap or easy, but in the COVID lockdowns, daycares closed, many of them permanently. They employ a lower wage set of workers who were in demand. So as the daycares closed down, those workers all easily found jobs, whether that's picking packages in an Amazon warehouse, jumping in at the grocery store, whatever. They were in huge demand. They all saw material pay raises. Daycares are not pleasant places to work. It's noisy, it's risky, it's hard for them to reopen. So parents may have no alternative to childcare than taking care of their own kids. But that will rectify itself for the simple reason that children get older to eventually go to school and parents' time will free up. We're watching immigration. Flows fell off. They were trending down. Then in 2020, almost every country shut their borders entirely. In 2021, we reopened and our consular offices were just not ready to start issuing visas again. So there was a real crunch there, especially for temporary workers. Think of like the camp counselors, the resort workers, agriculture workers who expect to just come for a few months and leave. They couldn't come last year. Now those flows are back this year, and that's a source of recovery. It's not all bad news. We've seen a rise in entrepreneurship. So some workers who appear to be gone have probably started their own businesses, and it takes a little while for those to appear in the data to track those. Could be working for smaller startups as well. So that's an interesting and encouraging trend to follow. And lastly, I don't want to dwell on this. It's hard to talk about, but total COVID mortality was mostly concentrated among older people, but we had over 250,000 deaths of people under 65. That is significant when we're wondering where that last 500,000 went. That's part of it. Let's just acknowledge that and move on. So when you have a crunch and a big demand for labor and not enough supply, the price goes up. In this case, the price is wages. And we've seen wage increases around 5 to 5.5% throughout this year. The good news, the glass half full there, CPI went to 9%, wages went to 5.5% and have trended down. So we didn't enter a wage price spiral. That's good. That's what happened in the 70s. Prices kept going higher, workers demanded higher pay, and then prices went up and so on. If we can keep wages under control, that's good news for curing inflation. That said, 5% is still really high. We never went higher than 3.5% in the last cycle. So this is going to remain an inflationary pressure, especially in sectors that rely on a lot of labor. It does, however, increase the ROI of any sort of investment in productivity that can reduce human contact. And you're seeing it everywhere, whether you're checking out your own groceries or placing your own food orders at a restaurant on your phone or their tablets. It's happening, it's upon us, and that transition is only going to increase. All right, so with so much going on, what's next for the Fed? This has been the hardest to forecast because here again, recency bias. In the last cycle, the Fed held at 0 rates for 7 years, then increased 1 quarter point move in 2015, waited another year before that next quarter point move, and really spread out the increases from there, made it up to about 2%, ended up cutting back a bit. So we are used to a cautious Fed. Absolutely not the case this year. Arguably, they took too long to start. I mean, hindsight is 2020. The recovery was outstanding in 2021, and we still had 0 rates and massive asset purchases, $120 billion a month of treasuries and mortgage-backed purchases by the Fed. Way more accommodation than we needed. It was the right thing to do in 2020. Probably should have tightened up in 2021, but they got their act together pretty fast. They've stopped asset purchases as of May. They've started running down their balance sheet as of June. And the rate hikes started in March. Way faster than anyone expected. Then it was remarkable to see a 50 basis point move in May. Wow. Okay. They're coming out big, they're coming out strong. And then in June, they leaked that they might do 75 basis points, and they did it. And they did it again last week. Huge increments. You have to go way back in history to find examples of the Fed moving this quickly to this sort of effect. But that said, the Fed has a dual mandate: maximum employment and stable prices. And as I just covered, unemployment, they're doing great. There's nothing left to do. And I mean, the risk is maybe hiring will slow down. We don't want to see the unemployment rate rise, but really they've met the employment mandate and they're blowing it on the inflation mandate. So this is the time. If they're ever going to move fast, now is when they do it. And the sooner they move, the more impact they can have to help control prices. They're not alone. I've called out as well here at the Bank of England, European Central Bank, moving way up. Great news for ECB. They're out of the negative rate regime. We expect they're going to move up. We think every bank is going to front load their rate hikes. We just saw Bank of England did 50 basis points today. They don't usually move in that sort of increment. So there's a consensus here. And it's a global challenge. Everyone's dealing with high inflation. So we're seeing similar moves together. I don't blame the Fed for the current inflation. It all comes back to COVID, and now somewhat as well to Russia. That has nothing to do with central bank policy. There was nothing the Fed could do to develop a vaccine. There was nothing the Fed could do to encourage the flow of goods through the ports of Long Beach and Los Angeles. So many of the challenges today are unrelated to interest rates, but they're trying. So they're raising rates. What does that do? It increases the cost of debt. So anything that's debt financed becomes more expensive. That's not the whole economy. I hope most of what you do in your daily life is not debt financed. However, it's having some predictable effects. We saw it right away in housing. Housing got really hot. I showed that in an earlier slide. Mortgage rates responded very quickly to the Fed hiking, nearly doubled for a while. They're back down a bit, but still, you can expect to get a 5% 30-year mortgage now when that was 3% just a year ago. That is quite an increase. Most people who are shopping for houses are shopping based on a payment, and not so much the headline price, but what can they actually afford based on their debt to income ratios and so on. When you have a 2% increase in a mortgage rate, that changes the entire payment calculation. So we're seeing a cooling, and we're due for a cooling. All right, housing is a sector where supply cannot catch up to a surge in demand. It simply can't. Under the best conditions, it takes 6 months to build a house, and these were not the best conditions. Materials were hard to come by, as was labor. So it's taking a while to build. The supply response is still working itself out. We will see more housing stock come online, but we're seeing a cooling in the housing sector. That's okay. Under normal circumstances, you'd expect the same in automotive. Most people who buy a car are using debt. If they lease, that is debt by definition. But there's so much pent-up demand from limited availability. We're not seeing any slowdown there. Cars are still being bought as soon as they can. So that's where the Fed's making difference. Of course, in corporate bonds, we are seeing some increase in the cost of debt. We're not seeing spreads blow out. The evaluation of risk has been pretty consistent. However, as the cost of borrowing increases, that does change investment decisions for businesses as well. But it takes a while. This is where monetary policy works with long and variable lags, and we have just done a lot of tightening in a short window. The 75 basis point moves are probably done. There's at most one more. They will likely slow down from here, and we expect they'll be done by the end of the year. Then see how markets react. I give the Fed a lot of credit for trying to control inflation when they could say no. We didn't cause it. We need action from Congress, what have you. But no, they're doing their best, even though I'm not sure they entirely can. Have they ever? Is a soft landing possible? I get this question a lot. This is where I've had to become a historian because I cannot give you direct testimony back to 1955. But if we think about it, are there any examples of the Fed raising rates and bringing inflation under control without spurring a recession? That's a soft landing. That's the ideal outcome. It is still possible. It's going to be very difficult. If you look here, you really have to squint. And I had some circles on here, but that made it even harder to read. But there were times that the Fed saw inflation moving up, raised rates, inflation got back under control, and there was no recession. Happened in, for instance, 1966. You can see the green line ticked up just a bit, but not the big one at the end of the 60s. Just that little tick up, helped to bring inflation down a bit, but the 60s were a boom time. Inflation kept going up, and the Fed did their best to try to control it without a recession. They did for a few years. It mostly worked. 1994, probably the clearest example. The Fed raised rates, really doubled them from 3 to 6%. Inflation did not take off, led to another boom in the 1990s. So it is possible, but those are examples of the Fed noticing inflation starting to get hotter and raising rates somewhat preemptively, or at least at the very start of an inflationary cycle. Here, we were already at 7% inflation when the Fed started raising. So they're behind the ball on this. It's not clear that just by raising rates and cutting asset purchases, they can really arrest inflation now. What we want, and what I sure hope we can avoid, is that Paul Volcker example. It makes me nervous when people bring up Volcker. Look what happened in the 1980s, just where that line goes wild. 19% overnight rate. We're debating, will we get to 3 or 4% this year? He went to 19. He deliberately broke the economy to arrest really a decade of uncontrolled inflation, sometimes worse than others, but it was too much. There was a case where Arthur Burns, the predecessor to Volcker, didn't do enough to control inflation, and Volcker had to make a big, expensive, risky move. Okay, we should never take recessions as plan A, and in fact, it was a double dip. Eventually, it worked. There was some luck there as well. That's when globalization took off in earnest. There were a lot of technology improvements along the way that helped to contain inflation. So I don't think we're repeating the 1980s example. I don't think anyone has the stomach to go quite that high. But when Fed speakers say we will act decisively, we take Paul Volcker as an example of a strong Fed leader. Boy, that makes me a bit nervous. I'd be remiss if I didn't talk a bit about Russia. I've mentioned them as a driver of the energy crunch, and this is where I'm most nervous. We still think a soft landing is possible, or soft-ish in the US, but the outlook for Europe just keeps deteriorating. Russia is using Europe's dependence on it for energy as a bargaining chip, doing their best to extract pain and hopefully extract some concessions. But there are no negotiations happening in good faith right now. Putting pressure on European nations when really the conflict is with Ukraine, it's all quite convoluted. It really just seems like a power play at this point, and it's going to do some real damage. So this is where we've come to expect a slight technical recession to come in Europe. There is tremendous resolve to push through this. There's a recognition that the assumption that natural gas would always be available and Russia would never compromise their position with us because we're such a world power, well, that's just not true anymore. So, the good news here is there are investments to come to diversify energy sources, probably head toward a cleaner future. There was always a good case to be made for investing in those sorts of projects. The transition was already underway. You've seen the solar fields and the windmills and the electric cars. That had already started, but now it's going to be accelerated significantly. Could be good news in a few years, but in the near term, it's tough. It's going to cause pain. And those investments on a financial basis aren't necessarily exciting. If you invest billions in new renewable energy and maybe nuclear reactors and so on, in the end, you're just going to get back to that same energy production. You haven't transformed the economy necessarily. I'd make an analogy to repairing your roof or your sewer line in your home. It's expensive, and in the end, it's the same home. You're not really appreciating anything new. You just know you're a little better off and you've made a worthwhile investment. So in the end, it doesn't really change your trajectory. It's a lot of investment with an unclear ROI. All of this leads to the most commonly asked question lately. I've phrased it here as, is a recession coming? But honestly, I more often hear, when will this recession end? How bad is this one going to be? I still don't take it as inevitable, but I understand the concern. And I'm sure you've all heard this debate. Are we actually in one now? Because we had 2 quarters in a row. Oh, I apologize. This is our last US outlook. We'll have a new one out soon. That showed we were hoping for a narrow gain in Q2. Instead, it was a narrow loss. So if you have 2 quarters of GDP contraction, isn't that a recession? Well, no. It's sort of a shorthand definition of one, but go look at the NBER. They're looking at labor, they're looking at industrial production, they're looking at all sorts of trade measures. On everything that the NBER tracks, we're doing well. I'm nervous a bit about real personal income has flatlined, not really falling, but inflation is certainly taking a bite. At any rate, by any standard that we've evaluated past recessions, we're not there. You really can't have continual job creation, 2.5 million jobs created in the first half of the year, and consider that a recession. It's not the right word, but as they say in politics, if you're explaining, you're losing. Sure doesn't feel like a recession, though I understand why there are concerns. I can tell you, wage gains are up 5%, even better for lower paid workers. Isn't that great news? But then someone signs their lease for the year ahead and it's gone up by 10 or rent goes up by 10 or 12%. It sure feels like a recession, doesn't it? I get nervous about the younger investors who maybe for the first time in their lives had some extra cash and some free time and started playing with stocks last year, or dare I say crypto. If you were in the meme stocks, if you were long crypto, oof, you're in a recession. I mean, that just hurts. All right, there was a correction there. And I'm sure that's contributing to a lot of this sentiment. We've never done, most of us have not dealt with inflation like this before. It is disconcerting. I can understand why it feels like we're pressured, but I'm just stunned to see these measures of consumer sentiment, which are totally subjective. They're done by phone. How do you feel about the economy? And whoever answers says, I just paid $100 to fill my car. I feel terrible. To see these measures surpass where we were in 2010 and 2011, to me is, I'm not a psychologist, but I feel like that's a coping mechanism where we minimize our memories of past traumas. We don't reflect on them so that we can move on. We had unemployment stuck over 7% for 5 years. People were losing their cars, losing their homes, walking away from their homes because they were underwater. Remember the jobless recovery. Remember the basements full of millennials? These kids aren't getting out and getting jobs. Well, there weren't entry-level jobs to be found. They simply didn't happen. That was an awful recovery, and it dragged on for years. Everything is quite good today. Prices are high. I'm not saying everything's great, but compared to those circumstances, we're doing well. Our outlook is the growth will continue with some challenges. We've had to revise down the growth outlook repeatedly, but just remember where we were. Last year, the US economy grew 5.7%. That's massive. After an awful year in 2020, that was a great recovery. Best we'd seen since 1984. So anyone under age 35 had the best economic year of their lives last year. We knew this year would slow down. No surprise there, it had to. 5.7% is too rapid growth. That's why we're still dealing with inflation today. We took off too fast. It's a long way from 5.7 to 0, and especially to go negative, as a recession would imply. So we don't think it'll get there. A lot of reasons to expect we're going to stay employed. We're going to keep spending. Inflation will peak, and we will just work our way through this one. Slower growth is still growth. I've outlined the case for why we see inflation coming down, and we do hope employment will hold. There is a chance of some job losses here. We do see the labor force continuing to recover. So just as a ratio of how many people are working over how many people are working or would want to work, could increase a bit. Anything under 4%, still great. Interest rates have been the absolute hardest thing to predict. We've had to revise this forecast so much. Didn't see the Fed acting so aggressively. When you see the Fed acting aggressively, you would expect the long end. You'd expect the whole yield curve to move up, and didn't. Flattened out. Inverted from the middle to the end. The 10-year again is in this declining. It didn't make sense to me that yields fell following the last Fed decision, and we do expect they do have some ground to recover from here, unless you're banking on a very rapid Fed pivot. That is just not in our base case. So not in recession today. That's present tense. I'm not saying no recession ever. It is totally plausible. If we've learned nothing else, we've learned a lot from COVID, but one thing should be to expect the unexpected. And it really feels like for the past year or so, kind of a Murphy's Law effect. Anything that could go wrong probably did. So that we're braced. These are low growth numbers. 1% for the whole year ahead. That's not good. And just a few complications can get that to negative from here. So we're not ruling out that case. It is not our baseline expectation, but you can see how it becomes just that much more possible. And then I'm going to spend the next 20 minutes telling you about myself. But you can, I hope you all have a copy of these slides, so feel free to ask me any questions now. I don't know what's come in. I haven't been monitoring the chat box, but ask away.
So far, there's no questions. So just
I've got a question. Okay, if I can ask.
Yeah.
So and I feel like I could have asked you this question every quarter for the past year and a half, but yeah, we're still dealing with COVID today. How does that play into your forecast as you look out to the rest of this year and out into next year?
Isn't that nice that I didn't even have a slide about COVID? But it's still with us. Yeah, I do. It's one of the browser tabs I'm never willing to close. I even track the state of Illinois every day. And if you look at those Illinois measures, and I think a lot of the country is in a similar place, we're still at a case count steadily that is comparable to last August. And what happened last August was the Delta surge. All those return to office plans got postponed. We were nervous about reopening schools. Like, we were so hesitant a year ago, and that's not to make light of people who really did get sick. We have loss of life. It was bad. However, we didn't enter a recession. The lockdowns were pretty limited following Delta. Then we had Omicron. This was, if we have to have a pandemic, Omicron was sort of a best case scenario where it spread rapidly, is now a subvariant of it is still spreading. Hospitalizations are quite low and mortality very low. That's encouraging. So I feel like in 2020, we put on this brave face and said, we're going to live with COVID, and we had no idea how to. We didn't have a vaccine. We didn't understand masking. We were wiping down our groceries with bleach wipes. I mean, it was all a lot of understandable panic. People were dying. We didn't understand why. And now we've had a couple years to figure out this virus and to live with it. Where I get nervous, who is not living with it? China. The rest of the world has moved on. China is still doing lockdowns a la 2020. China refuses to import vaccines. This has been, talk about a success story. And I know there are some strong opinions about vaccines, but say what you will about COVID. What happened with mRNA vaccines, the way they were developed and deployed, highly effective, inoculated the whole world. That's rapid. Tremendous progress that we saw there, and China will come around to it. They want to develop their own mRNA vaccine, and they were behind the curve on it. So I've heard a rumor it's coming later this year. I don't know. Instead, they locked down millions of people. They just did it again in a suburb of Wuhan. I think 1 million people are under lockdown after 4 cases were identified. And China has an important role in the global economy. They are still our factory. Now, again, I didn't even have a slide about China. We could talk about them all day. They are still important. They still do so much production. In fact, they've only increased their exports. As much as we put some pressure on them with tariffs and so on, when we had demand for goods, China was delivering, and now they're locking down again. Fortunately, it's just China, not the rest of the world like it was in 2021, but it's adding to that already pervasive uncertainty about China. Like, not only were they not the best trading partner to begin with, but now they've become unreliable in terms of making people available or getting shipments out on time. So that's the way we're talking about COVID today. I sure hope we're done learning Greek letters, but let's be humble. We know that these things can mutate and can spread. And while I'm on the public health topic, I'm getting occasional questions about monkeypox. Seems to be spreading slowly, seems to be survivable. It's not factoring in the forecast yet either. We do think that's another example of if we have to have a disease, this one seems to be livable. We've made real advancements in terms of diagnosis, in terms of working remotely, giving people paid time off, and so on. So I hope we can work our way through that one, but it seems to be spreading at a rate that's not yet a level of fear that would cause us to revise our forecast.
Hey, Ryan, we do have some questions that have rolled in. So the first one is, where do you see the S&P 500 by year end?
I am not an equity strategist. I shouldn't answer that question. Last I've heard from my colleagues who do track markets, expect gradual gains amid a whole lot of volatility. Like, they would push back on that premise of year end because they want to just think about the broad horizon. Still a lot of reason to have faith in equity markets. We had good news there. Related to COVID, we learned that markets don't panic twice for the same reason. big sell-off in 2020 that even as other variants emerged, there were little dips, but they always recovered. So I'd say markets are seeing their way through a lot of speculation now. I don't know what to say about the current boom. So I won't say anything. I won't even speculate because the market analysts I follow are all scratching their heads and trying to figure out what's been happening over the past week or so. It's encouraging, but is it here to stay? So the general direction is broadly slightly up. And that's about all that I'm qualified to say.
Okay. And then do you have any comments on fiscal policy and or tax increases?
Yeah. Yeah. That's getting busy. I'll have to dust off that slide because wasn't that something, how much fiscal activity there was through the COVID crisis. We had the CARES Act in 2020, bipartisan, huge spending package. Then another one in December 2020, and then Biden's first piece of legislation was the rescue plan, and then very little to speak of. Everything went dormant. Understandably, inflation concerns took off. We had an infrastructure package passed last year, and it looked like that would be the end of it. And even that infrastructure bill, though, made a lot of smart investments. I'd say overdue investments in terms of like the electrical grid and broadband. That was good, but you don't really see those for some time. Those projects take a while to build out, and they don't necessarily show up in the GDP figures that I'm tracking. They at least help employment. So I thought this would be just nothing this year. We saw a lot of reconciliation fights last year. So then, boom, we've had a couple of notable headlines out of Congress. CHIPS Act, this one's more philosophical. So for one, what I really like about the CHIPS Act is we've learned a lesson from COVID. It exposed that fault line that the world needs semiconductors, and the world had concentrated production in a volatile area in China and Taiwan. That's not optimal. That was the free market decision. They're very good at producing. It was cost effective. It was totally defensible. Every decision that led us there made sense at the time, but it led to a risk that we deemed unacceptable, and Congress acted, again, bipartisan manner, to support more research and more domestic production of semiconductors. Say what you will about subsidies to highly profitable semiconductor manufacturers. We're going to start producing again in the US. It's a strategic asset. It's hard to object to. So I'd say that's a smart move. There again, we won't really see the benefits of it for years to come. It takes a long time to build semiconductor fabricators, but I'm glad we're refocusing on building, on diversifying our production. Then the fiscal package, or the reconciliation package, that includes some new fiscal spending. So big support for clean energy. There again, I thought that would be part of infrastructure. It was a little bit, but now a little more movement toward it. That is good. It's really past time to retire the coal plants. We have a lot of technologies we haven't deployed. I'm not an energy expert, but I don't think we've really brought a nuclear plant online since the mid 1980s. There might be a one-off where a project that was stalled in the 80s got dug out and finished in like 10 years ago. But yeah, nuclear has come a long way. We just haven't actually deployed it. So by all means, let's do what we can to support clean energy. This is an investment in the future. And I'm happy to see that, as well as healthcare spending. I feel like we'll never be done talking about healthcare, but now there are some remedies to help control prescription drug prices. I think that's going to make a big difference for some people. We don't all have the same consumption basket, but people who use a lot of pharmaceuticals will hopefully see some benefit from there. So that's accretive. That will be paid for by a 15% minimum corporate tax, and that's where it gets thorny. We're already seeing there's some debate. Will this number be reduced? Will some of those tax provisions be changed? So I don't want to get ahead of that. It's not a done deal. The ink is not dry on this reconciliation package. We have to be careful anytime there's any sort of tax increase. Is that making the US less competitive? There are these discussions about the global minimum taxes for corporations. I'm highly skeptical that they'll actually gain traction. There's always going to be that incentive to defect and to charge something lower. So putting a minimum tax seems to be the compromise we've landed on. There was a big tax cut just a few years ago, and now some of that is being walked back. I think that's the way to think of it. Think of that as a brief stimulus for corporations rather than a walk back. I hope we stop there in that we don't want to create uncertainty. We don't want a lot of changes to the tax code. We don't want to deter future investment because it seems so unstable. But that said, anything that reduces the deficit, I think is long-term a good bet. So I like the focus of what we've seen lately, that it's thinking more long-term. It's not about immediate stimulus. It's not about, there's no risk of inflation in the things we're talking about. These are all multi-year projects. So I like the way these packages are coming together. As we think very long-term, sorry, I've been a bit long-winded on this because there's been so much to digest. Next year, there could be a 15% minimum corporate tax. There was no change to individual income taxes. Looking at the long term, Congressional Budget Office just last week put out their latest 30-year projection. They do it twice a year. We're on track. We're at 100% debt to GDP. It's higher than we'd like to see, but it appears to be sustainable. We can service that debt. COVID is just a blip on that trajectory. It's all demographics from here, leading us to higher and higher debt. We have an aging population. We have a falling birth rate. We have unsteady immigration. So we'll have more people collecting entitlement payments from Social Security and Medicare, fewer workers to support them. It just mathematically, debt takes off from there. That's uncomfortable. That's where it gets difficult, because it's going to be some combination of reducing those support programs and raising taxes at some point in the future. When we start struggling to close a debt auction, when we are at an actual risk of default, not just a synthetic default from the debt ceiling, but where there's an actual worry whether we can pay our bonds, it'll come one day. It could be 10, 20 years away, but that's where there will be some sort of reckoning. So the way I think of it, just to wrap this thought up, it's August. It's hot out. It was in the 90s yesterday, I think. I expect next week will still be hot out. 6 months from now, I don't know exactly what the temperature will be, but I'm pretty sure it'll be colder now than it is today. That's how I feel about tax. Look, I don't know exactly what the brackets are going to look like. I don't know what rates might move to, but I don't see a world where the rates don't tick up somewhat.
Okay. And then we have another question here. If you could just share your thoughts on your outlook for near-term prices in energy, especially with winter, believe it or not, coming up here in just a few months, how that will affect all.
So oil is the hardest to predict, but I've touched on that already. Hopefully we see some domestic production coming back, slower than we would have liked, but it will come back. Winter brings natural gas to mind. We are fortunate in the US. We have ample natural gas wells. We are mining them. As far as petroleum energy or hydrocarbon energy goes, it is fairly clean. So we're making the most of it. However, we also use it for electricity. And that's a problem we ran into last year. Remember, it got more expensive to heat our homes and our businesses well before anything happened in Russia and Ukraine. And that's because we had a hot summer in 2021, using more air conditioning, thus burning more natural gas to produce electricity, plus a hurricane that knocked a couple of wells offline. So that didn't help. We had lower reserves going into winter and thus paid more. Hopefully we've learned the lesson, but now we're getting into trying to predict the weather. Will there be another hurricane that diminishes production? We always hope not, but we have to expect the worst and hope for the best. So I just say we are insulated. Hopefully it's not another increase in the winter ahead like we just experienced last winter. The way these inflationary cycles tend to work, though, is the price levels off. It rarely corrects. Sometimes things get really hot and they bounce back down, but once we reach a new steady price, it's likely to hold there. I think that's the best case scenario, is we just get used to seeing heating bills like we saw last year, not necessarily like we saw in the decade prior.
Okay. And then one last question here. Why do forecasts have the 2-year and the 10-year treasuries at essentially the same rate?
Yeah, gone flat. This has been so hard. I'm sitting in this very office, I had to challenge my boss on some of this too. This forecast assumes the Fed goes into restrictive territory. Right now, they're probably neutral, not really restricting the economy yet at a 2.25% interest rate, but getting up to 4%, that's going to slow the economy down. They'll hold there until inflation shows a sustained correction back to 2%. which can happen next year, optimistically, at which point the Fed would start cutting. So those longer tenors are based on expectations of future interest rates. So when you've got, basically, think of it as a big wave on the short end. At the long end, they're sort of trying to gauge out how big that wave is, but it's still some distance away. And that makes it really hard to gauge any meaningful difference between the risk and payoff of 2-year versus 10-year debt, when we just know there's a lot of volatility on the short end, and thus we've seen compression. We have seen an inversion even between the 2 and 10, which is not always a recession predictor, but happens to be a predictor too often to be ignored. We are mindful of these fixed income dynamics. This has been really the hardest part of our forecast. We don't see a reason that the 2-year would really diverge from the 10-year. When you get into this sort of environment where short end rates are that volatile and that hard to expand, moving so much, there's not a material change in risk and thus not much of a difference in terms of yield.
Okay, that looks like it's it for questions. Thank you, Ryan. That was a very insightful presentation, very interesting. So thank you for that.
Thanks for having me.
Yeah.
Thanks, Ryan. So Matt, Dave, how are we doing on time?
We're getting close, but we'll give you a few minutes to go ahead and
All right.
work your magic on our portfolio. How's that?
I will keep my remarks brief. So Ryan did a great job of covering a lot of what's going on in the economy. So maybe I'll just quickly, give the bad news, kind of the reaction function in the market to everything that Ryan talked about. So if you look at returns in the second quarter, down across the board, both our risk control and risk asset returns were negative. We've basically given back on the U.S. equity returns year to date our gains we got last year. So we sit here today, end of the second quarter. We're hopeful that we may have hit the bottom on returns, but this was the second quarter in a row where we did see very negative returns across asset classes. As equity returns, the negative equity returns get a lot of pop news. You hear it on TV a lot. What you don't hear a lot about is how bad fixed income returns have been year to date in 2022. So just to put that into perspective, this chart at the top shows you exactly, going back to 2008, how weak the fixed income returns have been year to date that we've seen in 2022. Real quickly, we have changed our portfolio positioning and our client portfolios since we had our last call. We have moderated our overweight position on risk. We've brought our cash position up to an equal weight, still remain underweight investment grade fixed income and overweight to high yield. That's similar to what we had last quarter. We do have a slight overweight to U.S. equities, underweight equities as an asset class with underweights in both developed and emerging markets. We think there are outsized risks as you look outside the U.S. Before we would you'd be willing to put overweights on that area. And some new changes in the real asset side. We've added a small overweight to global listed infrastructure, where we think there is some downside protection in that asset class versus other risk assets. And we've brought our overweight to natural resources back down to a neutral weight, which is a new change, and it's highlighted up in the top box. And as advertised, real quickly, snapshot of the current positioning, underweight equities as an asset class, slightly underweight fixed income with a small overweight to alternatives coming from our global infrastructure overweight that we recently added. And real quickly on second quarter performance, this is our second quarter call. So if you look at this 3-month column, will give you a read on what the performance was for our main pool funds that we manage at Northern Trust and our FIA group. Our equity returns rebounded in the second quarter versus what we saw in the first quarter. So our equity returns were about 1% better than our custom benchmark. Our fixed income returns were a little bit weaker. That was a bright spot in the first quarter. We gave some of that back in the second quarter. And alternative sleeve, as you can see here, actually having positive performance for that sleeve of the portfolio was a benefit to performance in the second quarter. So all in, net of fees, performance for the main pool down about just over 8% for the quarter versus the custom benchmark of just over 9%. Year-to-date performance is back to flat. We're a little bit behind at the end of the first quarter. We've crawled back some of that performance. And again, through the second quarter, performance in the main pool fund was down about 12%, almost identical to our custom benchmark. Yeah, I won't go into some of the fund details. It's highlighted in the next few pages, some of the funds that we have. And I guess real quickly, and I'll try to keep this brief, I did want to throw a few slides up to kind of highlight why we include real assets in our client portfolios. I think this page is a good job of summarizing it. We add real assets to client portfolios for 3 different reasons. It helps diversify the risk asset bucket that we use to trying to generate returns for client portfolios. It has lower correlation to equity exposures, but still provides some inflation protection, which is highlighted in the bottom left-hand side here. So natural resources, infrastructure, and real estate provide some inflation protection. And in times like this, we're kind of dealing with negative returns. The income that's produced from these asset classes is very valuable. So you can see natural resources, infrastructure, and real estate have higher than global equity income produced for the portfolio. So I guess I'll pause there and see if there's any questions. I know we're kind of bumping up against time.
At this time, it does not look like we have any questions. So.
Awesome. That was great to be with everybody today. I'm looking forward to our third quarter call.
Okay. Thank you, Marty. As we wrap up, I want to thank Marty and Ryan for joining us today. Hope everybody thought today's webinar was informative. I also want to thank Matt for his help in organizing the webinar and monitoring the Q&A and chat segments. We hope you enjoyed it. Thank you again for participating, and we hope you have a great rest of your day. Thanks, everybody.
And if anyone has any thoughts, feedback, please reach out to either David or myself. We'd be happy with any information.
Thank you. Bye, everybody.